Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss, is direct indexing worth it? Earnings season update. Also, we're going to take a look at 401k in-service distributions and a visit to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing good. Yeah, as we're recording this, it survived Halloween, though pretty quiet in our place. We're not on the real popular street, so yeah, didn't have to stock up too much with all the candy.
We had was nice and mild in our neighborhood. I got out with my youngest and still wanted to enjoy that fun, so we had a good time. It gave me an excuse as an adult to break out my lightsaber, and nobody batted an eyelash. So, some fun was had.
There you go. Yeah, you got the one day a year. You can get away with that. You got to take advantage of it.
Yes, sir. All right. Well, we got some great topics we're going to discuss. So let's dive right in. Is direct indexing worth it? I think it's important to start with, what is direct indexing?
Yeah, so this is something that's become more and more popular, partly as expenses in the investment industry have been, driven downward through competition. Something I've seen as a big theme in my nearly 25 years. And so basically the idea is, historically you'd buy a mutual fund that tracks an index. So let's say the S&P 500. So that fund is going to buy those 500 companies in the right proportions to, try and match the index, which is trying to be a pretty good sample of the market as a whole. And then many years ago, we saw this shift to a very similar type investment vehicle called an exchange traded fund. But it offered some advantages. They were more tax efficient, and they traded, second by second like a stock, as opposed to settling at the end of the day like a mutual fund. So a lot of investment flows started shifting more and more towards exchange traded funds. And, in a lot of cases, you can get a S&P 500 exchange traded fund where the fee is so small. I mean, it's basically, not even a consideration. Because there's just so much money in those types of investments, and the scale as well as the efficiency has allowed providers to really drive down costs. But now we're seeing a type of investing that's becoming more and more popular, though I would say it's still very small, which is direct indexing, where you go in and instead of buying a single fund that owns all 500 stocks in the S&P 500, you actually buy those 500 stocks directly and attempt to match the proportions that they reflect in the index. So, instead of owning one single fund that covers all 500, you're kind of cutting out that middle provider and going direct.
So what kind of an advantage does that really hold? Does that hold for the, just the average investor, somebody that's maybe a day trader, or is this something that for example, in the situation that you folks there at Plan Solutions are in and handling different individuals' portfolios, that's an advantage there, or is it kind of showing positives for both?
Yeah, I think I think there are some advantages, and that's part of what we cover here. Although they're pretty limited to specific situations. And some people say one of the benefits of direct indexing is because you're not going through an exchange traded fund or a mutual fund. You're not paying those expense ratios.
Right.
But as I said, if you shop around and you pick the right fund, I mean, you can find them with such low expense ratios. I mean, the very, very small cost for the convenience of owning one fund and getting all of that diversification versus having to manage 500 different stocks and make changes as the index change, right? There are a lot of technology platforms and things that can be leveraged to do that more efficiently, but still, it creates a lot more challenges and to avoid a very small cost. So it's not really a cost decision. I think there's two situations where it potentially could be considered. So one would just be in taxable accounts. So if this is a non-retirement account, but it's an account where, if you buy or sell an investment, it's going to create a tax liability. And sometimes what you can do with direct indexing is you can hold all these different positions, but then you can go in and tax loss harvest when, some of them may be down for the year. So as an example, let's say you have an individual that has a very concentrated position. Maybe they work at a company, they've accumulated the stock, or maybe they got it through stock options or something like that and has a really large gain. And they're finally getting to the point where they're saying, I just have too much money in my employer stock, right? Huge part of my net worth is in my employer stock. My income is dependent on my employer's company performance. It's just too many eggs to have in one basket. And so, generally it would be prudent for them to create a plan to go in and start reducing their exposure to their employer stock. But when they make those sales, it's going to trigger a big gain, a big taxable gain, and potentially a big tax bill. Now, if you then take those proceeds and you reinvest them, right, and probably you're trying to get some diversification, so maybe you put it into something like an S&P 500. Well, if you just put it into one exchange traded fund and the S&P 500 goes up, that's a good result. Obviously, you'd like to see those gains, but you have no opportunity to harvest any losses. So there's nothing you can do to offset the loss from the sale of the employer stock that was generated. But if you do direct indexing or some form of that, there's a lot of different variations too, where maybe you don't buy all 500 companies, you buy a sampling to get, very close. But, some very direct indexing or some variation of it, even if the market goes up that year, there's a high probability that at least some of those holdings are going to go down, right? Out of 500 stocks, it'd be a very rare year where all 500 are going up. Generally, you're going to get a fairly large number that will go down in value. And what you can do is you can go in and sell those that are at a loss and capture that loss, which can then be used to offset the gain on the sale of the employer stock. So it can be very tax efficient. And as long as you wait 31 days to buy that stock back, you can always do the round trip and go back into it and still be able to take that loss against the gains. And then within a pretty short time period, be back to, once again, mirroring or somewhat mirroring the index. So that's one example. The other example really applies to all different types of accounts and really comes down to investor preferences, right? Let's say, I really don't want to be invested in certain industries or certain companies, either just, for personal reasons. It's might come down to, the typical ESG, environmental, social governance type factors or something.
Right.
Well, with direct indexing, you can get very close to the index, but then exclude some of those holdings that you just don't want to hold. Now, naturally, by excluding certain holdings, you will see some deviation from the index, and sometimes it's very small. Sometimes it can be quite large. We were seeing a real move towards ESG investing being very popular, especially during a prolonged time period where energy stocks were doing very poorly. But then things shifted, as they often do in these macro trends, and energy stocks started doing very well and were a big part of the return of the S&P 500. And those that had excluded them, then we're starting to wonder, well, wait a minute, why is my performance so much worse than the market as a whole? Whereas before it had been better. So it was, oh yeah, not only do I think this is important, but look, I'm also profiting from it. But then when people started not profiting and seeing declines, it was a different conversation, right? So there are risks to that. It's not, and so I think if people go that direction, they need to be pretty sure those are very strong convictions that are going to stick out through the different ups and down cycles, some of which can last 3 to 5 years, right, where you may see underperformance.
Sure.
And then finally, so let's go back to the example of an individual who has a concentrated position in their employer stock. Let's say that employer is a really big company, so they already represent a big portion of the S&P 500. Well, do you want to add more of that? Probably not. You already have even more than you'd want, right? So maybe you only buy the 499 stocks of the other 499, or again, maybe a smaller number, but it's more of a sampling of industries and things. But you're not, adding that much more into basically the stock that you just sold as you would be doing if you just purchased an index.
Well, what are some of the challenges with fees? I mean, I know for a lot of people and for me through reading this, I mean, that's kind of a sales point. Like, well, what is that initial cost? And do we see a change or a flex in what appears to be affordable and becomes less affordable over time?
Yeah, yeah. So the fees are a big consideration because, as we said at the beginning, you can get an exchange traded fund very inexpensively. In theory, you could go in and you could buy all of these stocks on a lot of platforms without paying trading costs, and there is no expense ratio to owning a stock. But you have to look at the platform fee, right? And this is an area where this is being pushed, I think, a lot more about generating the platform fee for the investment manager than saying, okay, do the benefits here really, exceed? I mean, I saw one recently where it was a Roth IRA, not a huge amount of money, but a decent amount of money. And here it's got, hundreds of positions because they're doing this direct indexing. Well, there's no tax benefit there because it's a Roth IRA, so it's tax free. Growth is tax free. The client didn't have any real concentrated position that they were trying to avoid. And, they hadn't put any restrictions on it around, ESG type factors or anything like that. So then you wonder, well, wait a minute, why are they paying a management fee and a platform fee to have, this all of these holdings that are very hard, when their statement is 50 pages long, listing all of the different holdings, and some of them, so small that it's like, it's less than $100 to try and replicate this index because these are, smaller components, smaller companies. So they're a smaller component of the index. And you think, okay, was this strategy really about, capturing that extra platform fee to make things really complex when none of the benefits of why you would do direct indexing were really there?
Sure.
And so I think that's why, people do need to, anytime there's a kind of new up and coming strategy or product on Wall Street, you always got to be a bit skeptical because you have to assume, I always say when Wall Street finds a new tool, they suddenly think it's the right tool for everyone, right?
Right.
We always had subprime mortgages, but then during the housing boom, suddenly Wall Street realized, oh, these subprime mortgages, these non-government backed mortgages are more profitable. Let's use these type for everybody, right? And then it became a huge portion of the market. And that led to a lot of the problems that we dealt with was they were looking at the short-term profits of selling those types of mortgages versus government backed. Whereas if all the mortgages had been government backed, we wouldn't have had the risk issues, and so we wouldn't have had the big declines that we saw. And I think this could be a similar situation where it is a useful tool in the right situations, but you have to be careful when you start seeing it used too much, and say, okay, could this create some systemic risks? Possibly. But also, is this just a way to create complexity to justify fees that aren't necessarily gonna end in a superior result? So at least at Plan Solutions, we have direct indexing options. We tend to do it a bit more pragmatic, and we use it in very limited situations because, honestly, it's not the right tool for every situation. But for some people, it might be the right fit. And we try to be, reasonably pragmatic. Where if you have a portfolio of a certain size, how many investments do you really need to include in that, right? Do you need to have a whole basket and pages of stocks, where you own one share or you own two shares and it's worth less than $100? Is that really, moving the needle on a $500,000 portfolio, as an example?
Yeah. Well, again, as you always state, you got to weigh the pros and cons of each and every situation, and it's good that there is that ability to take a look. I guess I'd like to close this section in asking as far as when someone does approach this type of investing, I mean, what are like three key questions that they would need to ask themselves? Because to me, it seems, that it hasn't had much longevity to really prove its worth.
Yeah, I think really, as a financial planning firm, that's where we're going to start, right? And so
Mm.
it shouldn't start with the solution. It should start with the question. And the question is, what are we trying to accomplish here, and what are the tools that we can use? And if it naturally leads in that direction to having that conversation, then that makes sense, right? But I think in those situations, I mean, the first has to be, okay, is there a tax benefit here, right? Is there a diversification benefit? Or is there a really strong preference on the client's part where, they're committed to, sticking with a certain strategy because of those strong preferences? If one of those three or multiple of those three exist, then maybe it's something to, weigh the pros and cons. And then, weighing the pros and cons are, okay, let's look at the costs, right? Let's look at the size of the portfolio, and does this make sense? In many cases, there's fairly large minimums for these types of programs too, so it may not even be feasible. So you want to weigh those pros and cons, and then weigh it versus other ways in which you may achieve the same result, right? I mean, if using the example from earlier, if the client has a really strong preference to avoid, oil and gas type companies, there are mutual funds that you can use that exclude those. So you don't necessarily need to do direct indexing. But direct indexing, may be the only option if someone has very specific views that are different than just some of these normal categorical issues, in which case then you need to get a bit more granular. So then maybe it's worth them to, the extra fees in order to achieve that result.
All right. Well, let's jump into earnings season. Let's take earnings season update. Hey, it's off to a strong start. I mean, things are looking pretty positive here.
Yeah, it is. It's still early. We've only had, about a little over a quarter of companies report. But out of the 166 companies in the S&P 500 that have reported, 127 of them, or just about three quarters, have beat their earnings estimates, and only 31 have fallen short. So, it's looking like the momentum that we saw pick up in the last quarter is continuing through to this quarter. And big picture, if you look at if the current earning expectations continue for the remainder of the companies that report, which obviously we still have a ways to go, but it's expected that the S&P 500 will report $53.77 in earnings, which is just about a 13% increase from the same quarter a year ago. So strong year-over-year growth. If these results hold and we continue to see the early trend, continue through the end of earnings season.
So far, out of the companies that have reported, what are the strongest sectors that we're seeing?
So we're seeing consumer staples, right? So those are kind of the necessities, food and things like that. Utilities have been strong, which, is a little bit of a surprise, but utilities have benefited from increased energy demand, a lot of it around AI. And so for the first time in quite a while, we've actually finally seen some movement in energy stocks. Technology has been strong, right? Which has been a theme. Obviously, a lot of investment in AI and some of the chip capacity and other things going on. And then healthcare has been strong, which has been an area that struggled. So maybe we're finally seeing some shift, to the positive there.
Yeah, well, when we still have some ways to go in earnings season, but I mean, strong results so far. A nice quarter of where potentially the economy is heading, and
Yeah, I hope so. Hopefully, and we've seen stock prices do pretty well. So I think to an extent that's already priced in, right? So the positive earnings will probably at least justify current stock prices, and if they continue to beat expectations, maybe there's a bit of upside there. But we do need to be careful and watch for any downside surprises, because if 13% earnings growth year over year is already priced into the market, if we start to see some weakness and things falling short of that, then potentially we could see a downward adjustment in the market as it kind of, right levels itself based on where actual results are.
All right. Well, let's take a look at 401k in-service distributions. What is a 401k in-service distribution?
Yeah, so this is something a lot of people aren't aware of, and in some cases it may or may not be allowed. It's not a requirement, but it's something that you run into. You basically, it's when you're working and participating in an employer-sponsored plan like a 401k. Generally, the money has to stay there. And there's there may be like a brokerage window or some of the things that can give you some more flexibility, but it has to stay within the overall bounds of the plan. Mostly because of a lot of Department of Labor rules that the plan has to adhere to. And in order to be able to do that accounting accurately, they need those records and they need the money to stay within the plan. But some plans, if a person's over age 59 and a half, which is, generally the point when you can take money out of a retirement plan penalty free, and even though they're still employed and participating by making contributions, the plan may allow in-service distributions where they can basically go in and take the money out and spend it, move it to an IRA, do other things with it, just because they've reached that age where they otherwise would be allowed to get access to the money. The employer probably wants to incentivize them to continue working and not, have to leave in order to get access to that money or have that flexibility. So it's just something for people to keep in the back of their mind, that you may have more options once you hit that 59 and a half, assuming your employer plan allows it.
Yeah, it's really pretty interesting. I don't recall us covering this at any point in any of the years we've been doing the Plan Solutions Incorporated podcast. So pretty interesting stuff. Anything else you want to add here to it before we move along to the bulletin board?
Well, just that, you still want to weigh the pros and cons, right? Of leaving money in a 401k versus an IRA. There can be cost considerations. There can be considerations in terms of flexibility of investment. There might be issues just around, individuals' goals and what's the best fit. But knowing that this option is available, it may be worth having that discussion if it's, if it's a situation where someone could benefit from it.
Yes, sir. All right. Well, let's take a look at the Plan Solutions Incorporated office bulletin board. We've got one item pinned up there.
Yeah, and this will probably be a theme of additional numbers that we usually get around this time of the year, which is when the IRS goes through and starts doing their inflation adjustments for the coming year, right? Many items in the tax code are adjusted for inflation. Around this time of year, the IRS comes up with that official inflation estimate. And then you see, the standard deduction, the tax brackets where they begin and end will all move, based on that inflation adjustment. And the most recent one that, affects a lot of people these days, with the standard deduction being much larger than most people's itemized deductions. The IRS announced that the standard deduction for 2025 will increase by $800 for married couples. So it'll be up to $30,000 of basically income that's tax-free to start. It'll increase by $400 for single filers, which gets to $15,000, and then by $600 for head of household filers. So that's at $22,500. So just a little additional income that will be tax-free. That people will be able to take advantage of. Of course, those that do have large deductions for things like mortgage interest, taxes, charitable contributions may still benefit them to itemize their deductions. And in many cases, a lot of people, even though they may take the standard, that large standard deduction on their federal returns, they may still need to itemize to get a state benefit. Because in many cases, states did not conform to those tax law changes when they were implemented back in 2018.
Yes, sir. Something always important to keep in mind. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Just that this is a great time to be thinking about tax planning since we're on the topic, and so we get closer to the end of the year. We've got a couple months, and these are a period where a lot of times some adjustments or changes might need to be or might able to be made, to see some benefit on the 2024 taxes when they're filed.
Yes, sir. Well, we thank you all for listening or watching the Plan Solutions Incorporated podcast. That's right. We do have the videos up on YouTube where you can watch along. You'll follow along to the personal financial review, the written content we discussed. Just search at Plan Solutions there on YouTube, or as always, Apple Podcasts, Spotify. Please leave us a rating and a review. And if you're getting value out of this content, share with someone else. And if you have yet to subscribe to the personal financial review, the written content we are conversing about, send Katie an email and get subscribed today. That's KATIE at plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.